really like to know the audience I'm talking to, and a lot of you guys, I don't really know you super well. I'm sorry for that. Still new to the server, so I don't necessarily know where everybody's knowledge and skills are at. I as we go through each topic, I'm going to ask you guys, and I'd like you guys to get involved in trading chat. If you guys understand what a liquidity pool is and how it works, throw a 1 into trading chat. Let's see how many of you actually understand liquidity pools. Mike, I'm just assuming you're going to throw a 1 for everything today. Learned today. Okay, perfect. Learned today. Good answer. All right, how about the rest of you? 0. All right. 0.5 Bo. All right. Lulu, Damien, how about you? Come on. Jump into trading chat. Let's hear it. 0. Okay. So it sounds like so far we don't have a lot of experience with some of the basic ideas. Okay, so let's talk about liquidity pools then. All right, what is a liquidity pool? A liquidity pool is what gives your commodity or your asset or whatever a value. All right. So an article was published on the website today. There's a link to it in one of the channels on the server. So it sounds like talking about liquidity pools, and there's an analogy I used. Okay, there are 2 villages. Oops. Oh no, I'm on the wrong button. Okay, there are 2 villages. All right, in this great land that we all live in, and we'll call it Earth. Now, in your village, they make pew-pews. And it's wonderful. Everybody makes pew-pews. You make pew-pews. Your father makes pew-pews. Your brother makes pew-pews. Everybody makes pew-pews. Pew-pews are guns. But none of you make bullets. And you need bullets to fire the gun. Well, you decide to start traveling and exploring, and you come across this neighboring village. And in this neighboring village, they all make bullets. So it's great. You need bullets. They've got them. They need guns. You've got them. And so you agreed to trade. And that's wonderful. Okay. So the question is, how much of your guns do you have to trade? And you say, okay, I've got 1,000 guns to trade. And they say, okay, great. I've got 1,000 bullets to trade. But here's the thing. It's not going to be one of you trading, and you both know it. Now that you know of each other's existence, you're going to trade with other people in the armorer's village, and they're going to trade with other smiths in your village. And so you don't want to be competing each other. It's called a race for the bottom. And you don't want to do that. You don't want to get stuck undercutting each other. And so what you decide is how many guns and bullets flood the marketplace. These assets are going to have a fixed pool of value to them, a fixed liquid capital available to them. And so what you say is, okay, that liquid capital is going to be, say, $1 million. Okay. And so here we are, $1 million, which conveniently 1,000 times 1,000 is $1 million. And so regardless of how many guns and bullets are in the marketplace, the value of all those assets is always going to be $1 million. Okay. Now, let's say further down here, several months go by. Everybody's happy, right? There's guns, there's bullets, they're flying around. I can buy more guns, I can buy more bullets. It's awesome. Okay. It's like Christmas in Texas. Okay. But Bob comes in, and Bob says, okay, here's Bob. I'm a terrible artist, by the way. Bob says, I've got 200 guns. How many bullets are you going to give me for those 200 guns? Well, here's the thing. There's already 1,000 guns in the marketplace. And so now, thanks to Bob, there's going to be 1,200 guns adding to the overall available number of guns. So that's like that's your market cap, right? So that is the available quantity to the market. Okay. And so here's the deal. When you add, you decrease the value. The value goes down. Your guns aren't worth as much anymore because there's more guns in the marketplace. And so what happens is we say, okay, well, we've got $1 million of liquidity available, and we now have 1,200 guns in the marketplace. And so we're gonna say that Sean can't draw for shit and should have drawn that a little bit differently. We're gonna say that there you go. We've got $1 million divided by 1,200. Okay, and we're gonna say, okay, so that equals 833. Well, it's actually 800. Yeah, 833.333, whatever. Okay, we're just gonna say 833. Keep it simple. Okay. So this says that if I have 1,000 bullets, okay, and you have 1,200 guns, or sorry, you have 200 guns, when I give you the bullets and you give me the guns, there should be 833 bullets left in the market still available. And so that means that you get 833, or sorry, you get, was it 1,000 minus 833 equals 167. There you go. So Bob gets 167 bullets, which means Bob's 200 guns are only worth 167 bullets. Why? Well, exactly what we talked about here. 1,000 bullets and 1,000 guns equals $1 million. Bob added 200 guns to the equation, which changed the balance. So that increased the value of the bullets and it decreased the value of the guns because there was now an imbalance introduced. And that is essentially how liquidity pools work. It is a fixed pool of money. You could add to the pool, sure, but it is a fixed pool of money that gives value to an asset or a commodity. And so in the case of cryptocurrency, maybe bullets are Bitcoins and maybe the guns are Ethereum or US dollars or whatever. Okay. And so the more Bitcoins that are minted, the lower the value they have. But though also is equally true, the more Bitcoins that are taken off the market, the greater the value they have. And this is how liquidity pools work. Okay. Any questions so far? So go ahead and throw them into chat. No such thing as a bad question. Everything's a good question. Give you a minute. Nothing. Wow. Okay. I can't possibly imagine I explained that in like 10 minutes super clearly. Similar concept to supply and demand. Yes, this is actually a visualization of supply and demand. Bob wants 200 bullets. You've got the gun. Bob's offering 200 guns. That's his bid. Okay. And you're going to pay him 167 bullets. That's the ask, right? So this is where and the spread in this case would be 167 minus 200. So it's yes, supply and demand is what drives the division within the liquidity pool. Liquidity pool means how much liquid cash is everything that you have actually worth. So have you guys know what a shit coin is or a poo coin, right? Like Safe Moon and all those coins, right? Like those are what's called shit coins, right? You guys understand what those are? Shitcoin is not a technical term. It's basically a coin that's on like an unknown, unreliable exchange that Bob down the street made a it's not necessarily reputable, and you don't know if they're going to rug pull the liquidity or not. That's basically what a shit coin is. Let me give you a crypto example of liquidity. Sheesh token was a coin that came out, and it was a coin that was created by a TikTok influencer. This is probably going back about 8, 9, 10 months ago. Everyone went bananas for this coin. Okay, everyone kept buying the coin, and it drove the coin's price way up right at the top. But what happened? As soon as the price, took off and went 10 times, everybody started selling. Except here was the problem: the developers also started pulling money out too. Well, when that happened, there wasn't enough liquidity left. Oh, stream closed. Yeah, it's my tablet went to sleep. I'll restart that. There wasn't enough liquidity left for people to actually be able to sell. And so what happened was you were actually stuck in a situation where you might have, say, 4,000 sheesh token. Sorry. Okay. Can you guys see that now? You guys might have 4,000 sheesh token, but you can't sell it. Well, why can't you sell it? A, there's not enough liquidity left, and B, there's not enough buyers. People aren't buying. They have to be buying for you to be able to sell, right? I'm sitting here with a cup of coffee. I could offer it for sale, but if nobody's willing to pay the price I'm asking, guess what? That cup of coffee doesn't get sold, right? So bid and ask. So maybe I've got to drop the price of my coffee, and then one of you says, okay, yeah, I'll buy it. So maybe I sell it for $10, and Lulu, you're all only willing to buy it for $5, and so maybe I got to come down to $8, and you've got to come up to $8 or whatever, right? And that's how kind of how bid and ask work is. I will put out something for a price, and you will put out something for a price, and either we match or we don't, and one of us either moves up or one of us moves down. Now, it's interesting because that's kind of where market makers come in a sort of official capacity within the trading world. Is that market makers' job is to ensure that there is always liquidity available in the marketplace. Because let's be honest here, right? Not everyone is willing to pay $50,000 for a Bitcoin, right? Maybe the market ceiling's at $48,000, right? But people are trying to buy it at 50 or sell it at 50. And so that's where market makers come in. Their job is to close the spread, close the gap. They assume the risk on behalf of various exchanges and whatever, right? And they create that liquidity. So now we get in, let's talk about bid and ask and the spread a little bit. So we're going to move on to the next page here. So bid and ask, okay? If you look at, you guys have all looked at the order book before, right? So here's your order book. You've basically got a table with 2 columns, right? Buy and sell. Okay. And so maybe I'm willing to sell something for $50 or buy something for $50, but the closest price to me is $57. And so there's no sale to be made. Maybe it's like $83, $98, $150, whatever. And I realize I'm writing this in reverse order, but if you don't have a matched price, like for instance, okay, let's say that this 57 is actually 48, okay, and I'm offering 50. Well, now there's a sale that can happen, right? And the difference between the two prices, that $2 difference, is the spread. It's the difference between the bid and the ask. Okay. So do you guys understand now what bid and ask is? Bid and ask are pretty simple concepts. They're not that complicated. Okay. And you guys understand the spread? It's the difference between the bid and the ask. So in our example, we've got to buy for $50, we've got to sell for $48, and the difference between the two is $2. So we've got a spread of $2. You guys understand that, right? Okay. So on to the retail trader. So you guys have heard this term a lot, and not necessarily always in the most flattering of ways. A retail trader. What is a retail trader? Well, let's start with what is a retail trader not? Okay. So we've got three columns here. So we have the retail trader, we have the institutional trader, and then we have market makers. I'm just going to put MM. Now, I want to be clear about one thing before I dive into this. There is the whole conspiracy theory around what market makers are. And then there is the real world, what market makers actually are. Okay. I don't like to live in fantasy land. I prefer to stick with reality. So we're only going to talk about what market makers are in a real world capacity. Okay. Into government conspiracies and all that crap. So that is not what any of this is going to be about, if that's what anyone is expecting. Retail traders, okay, typically they've got a wallet of under $1 million in capital. Okay. Now, most retail traders, the average retail trader is probably realistically under, say, $100,000. I would say, I would dare say many retail traders are under $5,000, but let's just say under $100,000. Most institutional traders, okay, and well, I shouldn't say most institutional traders, but most institutions that commercial brokers and investors represent are typically worth tens of millions of dollars, or more in some cases. Okay. They typically represent multiple clients. Retail traders represent themselves. Institute and maybe some sort of certification or license. For instance, in the U.S., depending on what you're doing, maybe you have to have your Series 7 certification to trade in certain markets, and it's similar in Canada as well. I'm sure it's the same in Europe and in most places. But typically, retail traders are uneducated. Now, when I say uneducated, I don't mean that they haven't gone to school or that they aren't smart. I mean that they are not trained in financial markets or economics. And so they don't necessarily understand all the concepts that need to go into professional trading, okay, or high risk trading, okay. Institutional traders will usually have access to private exchanges. This is not always the case. Okay, this last point on I'm going to say about institutional traders. I'm going to say retail traders typically use retail exchanges. It's not an actual term, to be honest with you. I don't really know what you would call it. I'm a retail trader. But like when I say like retail exchanges, I'm talking about like Robinhood or like Ameritrade or like Binance or things like that. Institutional traders will typically have access to exchanges that, you or I do not have access to. It's done that way because for several reasons. One, um, institutional traders don't necessarily want every trade listed on the market openly. Sometimes there's just transactions that happen quietly behind closed doors. You don't want it public. Some of these are very large transactions. Some of these are very small transactions. And it's more about the individuals involved than it is about the money involved. But a lot of the time, it's the money involved. Now, the thing to note about private exchanges is they do impact the market. In fact, they can have a very profound impact on the market. And so it's a little frustrating for retail traders because we don't see everything. We don't get the complete picture, whereas institutional traders will typically have a much better view. So, for instance, I spent several years working in fintech and writing trading algorithms. And one of the things that we had access to as a fintech and as the licensed brokerage was we actually had access to real-time feeds from markets all over the world. Retail traders most commonly not have true real-time feeds. It's usually delayed by anywhere from 15 seconds to 15 minutes. And you might think like, hey, 15 seconds isn't a long time. But when you're the kind of trader that's doing scalping, 15 seconds is an eternity, especially when you're working at something like 125 times leverage or whatever. When you're working at really high leverage or with really large dollars. Now, I don't know how it is in other markets, but from what I understand, things like 120. That's more a crypto thing, if I'm correct. Mike can correct me on that one in chat. But 15 seconds can be an eternity. And in a trading algorithm, 15 seconds is definitely an eternity. You are reassessing your trade viability every second when you do algorithm trading. So institutional traders will have access to all of this data in real time. You're talking news feeds, sentiment data, market data, order books, order flows, like everything. They will just have everything. And that's why you see these professional traders have like 4 or 5 different monitors because they're actually looking at a lot of different data all at once to get confluence. And we'll talk about that. Now, I left the market maker column blank because market makers are a little bit different. Market makers, typically have hundreds of millions of dollars behind them. Now, could you be a market maker with less than $100 million? Sure. If you're working as a collective with other market makers, you absolutely can be. Market makers could be an individual, but most commonly they are part of a group. They can be hedge funds, they could be central banks, they could be large corporate level investors with billions of dollars behind them. There's no legal requirement as to what or who can be a market maker because you are not trading to the you're not a broker per se where you are necessarily trading to the retail consumer. Depending on how you operate as a market maker, you may or may not necessarily be licensed. Some of it has to do with what countries you're operating out of. In North America, if you were a market maker, as I understand it, even if you're not selling directly to retail traders, you are still conducting trading, and so you still have to be licensed. I don't know how it works in Europe in this regard. If it matters if you're selling to retail traders or the public or not. But these traders are tasked with specific objectives. Their job is to make sure that there is always liquidity available. So let's go down a page for a second. We're going to come back to this page. What do I mean by making sure there's always liquidity available? The market does not just move. Whoops, sorry. The market does not just move like this. It does not move like that. It does not move in a single direction. The market moves in a wave, and sometimes that wave goes up high, sometimes it just consolidates, and sometimes it just comes crashing down, right? How does the market do that? Well, there has to be price fluctuation, there has to be volatility, and there has to be people that are willing to buy and sell at all levels, okay? So what happens if I'm all the way up here with my sale? Let's zoom in here for a second. Let's say I'm all the way up there and I'm trying to sell, but there's nobody available to buy. There's no buyers available at this level. All the buyers are down here. They want to buy low. Nobody wants to buy high. Everybody wants to buy low, right? So what happens? The maker says, you know what? I'm going to buy your stock. I'm going to buy your coin. And I'm going to eat the cost of that right now. Now, market makers are not in the habit of losing money. So this is what's called, this creates what's called a liquidity gap, because the market maker has used liquidity to buy your coin. And what's that do? It drives price up even higher. And so what happens? Well, maybe earlier down on the down the road, like way back here, way back here. Maybe a market maker came along and they bought a bunch of stuff all the way up here. So what do they start doing? Okay, they start selling it as fast as they can, and this is where market makers come in. It's not just Bob sitting there selling it to you. Bob might sell it to himself and buy it from himself at a lower price, or Bob might sell it to, say, Johnny. And Johnny's going to buy it at that lower price. But what's going to happen is as those large orders start getting sold off, what happens? Price starts to come down, because all of a sudden there's more and more market cap available. There's more supply than there is demand now, and so price starts coming down. And they do that. Market makers do that purposely, because if price stays up here, who's going to buy? Who's going to buy up there? Nobody buys at the top, right? Everybody wants to make money. Everybody wants to buy right down here in the dip. So they know full well that what they've got to do is they've got to drive price down sometimes. And then other times they've got to drive price up, because everybody keeps buying at the bottom, but not enough big transactions, or not enough capacity is actually moving. And so sometimes they've got to buy those volumes themselves. And so you'll see those orders go through for like 400 Bitcoin or 1,000 Bitcoin or whatever. And it's done to drive price up, right? And so that's the role that the market maker plays in the real world. Is their job is to make sure that there is always volume in the market, that there is always liquidity available, no matter what. And that the coins and whatever doesn't just stagnate and sit. They don't care about the actual price. Like the market maker doesn't care if Bitcoin is worth, $1 billion. It doesn't care if it's worth $5. Market makers get paid on the spread. Market makers get paid whether they're going short, just like we get paid if we go short, or whether they go long. So they really don't care about price. And so one of the marks of a good trader is a trader that doesn't talk about, oh my God, I need Bitcoin to go up in price. Yeah, maybe you do if you're holding. And if you've got it as a spot, sure, you want it to go up. But if you're trading on leverage, and if you're a trader that's doing that kind of trading and focusing on leveraged trading, well, then you don't care if it's going up or going down. If it's going down, you short. If it's going up, you go long. And the market maker's job is to make sure that the market is always moving in a direction. Okay? Any questions on that so far? I realize this is a very, very high level overview. We'll go into it in detail in a future session. There's a lot of meat and a lot of things to unpack about market making. But any questions so far? Okay. All right. Perfect. So now let's talk about finding patterns. Now you guys have heard of this before, okay? I mean, like every trader knows this. Like, okay, you've got what your ascending wedge, you've got your descending wedge, you've got like a lateral wedge, you've got like what your channels, you've got like your oh crap, I never remember what they're called. Basically, just boop 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 up and reverse, whatever. Yeah, you've got head and shoulders, inverse head and shoulders, Elliott wave. Thank you, Elliott wave. I never remember ET. Um, you've got inverse head and shoulders. You got all of that, and then let's add insult to injury. Everybody's favorite. You've got fractals. Okay, fractals are fun. If any of you like to just like basically rub your balls with sandpaper, that's fractals for you. I tried to get my head around them once. They're just insanely complicated. I prefer keeping it simple. And for me, for the way I trade, fractals are too complicated. Okay. These simple patterns, I've found, honestly, out of all of these patterns, these are the most useful ones. Okay. Head and shoulders is obviously kind of useful. There's M's, there's W's as well. I find simple patterns, your wedges, your channels, your Elliott waves, your M's, your W's, that's really all you really need to get by if you are a retail trader and this is not your main source of income. So yes, you can complicate this infinitely by going into things like fractals and even more complicated patterns. But if all you want to do is retail trade, extra cash, this is really what you can get by with. And I'll tell you right now, I opened 9 trades this week. I won on 6 of them. No, 7 of them, sorry. And really like the only pattern I looked at this week was an Elliott wave, and a wedge and a channel. I didn't even bother looking for anything else. Ultimately, what's going to determine if you win or lose in a trade is your preparation and your ability to take your emotion out of it. As soon as you introduce your emotion, fear, and anxiety, you've lost the trade. You're going to pull out too soon. You're going to pull out at a loss. You're going to jump in when you shouldn't. You need to take fear out of it and take your emotion out of it and look plan, because if you've got a good plan, you're going to win. All right. Maybe not every time. I didn't win every trade this week. Sometimes it just doesn't go the way you think it will. There's nothing you can do about it, and that's okay. But take your emotion out of it and stick to what you're looking at. Let the charts do the work for you. So, with that said, we're going to look at a chart for a moment here. Let's go over to Trading View for a second. Indicators here, because really I don't want to overcomplicate this for you. Okay. We're going to look at just candles here. Okay. And for the record, by the way, with patterns, that does include support and resistance levels. So don't think it's not important to mark your levels. It actually is. Me as an exercise, one of the first things I will typically do when I am doing my TA is I will actually go right to here. Oh, there. Okay. We can actually get rid of that because that is no longer correct for this week. And I will actually mark out like key levels. So for me, I'll go through and identify like weekly levels. Then I'll go down and I'll identify like my daily levels. And what I'm looking for here when I'm marking this out, and for the record, I don't go crazy on this. So I have not marked this out for this week. Time